inflation threat at all. And if that is the principal reason for implementing quantitative easing, we're going to have to drift back into a much, much worse state of affairs than we are in right now, soft patch notwithstanding, before they would consider doing QE3.
Okay, Douglas, let me pose that question across to you. Now, the end of QE2 comes just as the U.S. economy is losing steam. Growth, of course, has slowed sharply in the first quarter, and data really has to yet signal a quick recovery. The jobless rate remains high at 9%. Do you think the timing for the Fed has not really been ideal?
Now, timing is a tough question with monetary policy because there are questions of whether or not it did work, but also of whether or not it will work, because you can look out 6 months to a year from now and perhaps still see the effects of this quantitative easing. Let's remember, they're turning off the faucet today, but they are not pulling this cash out of the system, and they'll be using the proceeds of these investments to reinvest. So that said, yes, at the time that quantitative easing 2 was announced, it was really done so to fight deflation. The Fed has a dual mandate, and that's price stability and maximum employment. So they were more concerned with the effects of deflation in enacting this policy. But looking over at the jobs front, we're kind of in a catch-22 here, where the consumer is not going to be confident until we get jobs growth. But businesses are not going to hire until they see a confident consumer. So we're kind of in between a rock and a hard place in that respect. But again, I think it's way too early to give a pass or fail to quantitative easing, and I think the effects will be seen over the next few quarters as well.
Right, Rob, let me bring it across to you now. There is, of course, a view that the Fed may signal as soon as August that it stands ready to print more money if the economy worsens and recession really starts to look like a real possibility. Is it likely?
I think it's very unlikely, actually. I think the more likely outcome is that the data from July onwards starts to show signs of improvement. And if it does so, then really what the Fed is most likely to be signaling to us, rather than any concept of further monetary printing, is some move towards the exit strategy. So all the money, the $2.5 trillion on the Fed's balance sheet right now, some of that will have to be taken off the balance sheet during the process of normalization, and the Fed could start telling us what's the process involved, how do we work through this. Is it simply a question of allowing some of the assets on the balance sheet to mature and drop off in a very passive fashion over a long period of time? Will there be active selling? What are they going to do, for example, with the interest on excess reserves? Do they need to start putting that up in advance of any increase in the Fed funds rate itself in order to drain liquidity? So I think that's more likely to be the sort of talk we get in August, should the economy start to show the signs of improvement that we believe it will by then.
All right, Douglas. Now, of course, all that cheap money has sparked a stock market rally. The benchmark S&P 500 is up some 25% since August 26th. In fact, just the day before Bernanke really hinted at that second stimulus package. It also helped boost oil prices. How is life without QE2 really going to look like for the markets right now?
Okay, that's the $600 billion question here. And I can say, once we got the rumor of quantitative easing 2, the markets began this stair-step rally. No big moves, but 60, 70 points a day. And when all was said and done, we had ourselves a 25% gain in a very orderly fashion. In fact, historically. But, you know, that said, once we're done with this program, it's kind of getting back to reality for the markets. And, you know, while this did put pressure on commodities, which of course then put pressure on the economy itself, the removal of the quantitative easing 2 will give us a much clearer picture of exactly where this economy stands. Now, Chairman Bernanke did say recently that those pressures of commodity prices at high levels were transitory and likely driven by the emerging markets, and they would stabilize. And also, I think the lack of panic at the recent FOMC policy meeting tells you that they see the softness, the recent softness in economic data, you know, as really a product of the Japanese situation and poor weather here over the winter, and that those will subside as well, and the economy may actually grow pretty nicely second half of this year.
Great, Douglas, many thanks for joining us as always this morning and sharing your views as the QE2, of course, comes to an end and answering that $600 billion question. Let's, in fact, also get you a view from billionaire investor Wilbur Ross on whether there is a possibility of a QE3. Now, the FOMC hasn't really indicated another QE3. Is that something that can be safely ruled out, or are we likely to see interest rates beginning to rise in the second half of the year? Here's Wilbur Ross with his view.
We believe that if there is a substantial cut in the federal deficit made as part of the current negotiations about fixing the budget and expanding the debt limit, we believe that if there is a substantial near-term cut made, that increases quite greatly the probability of a QE3.